by Brian. If not, the rest of the day is going to be a really well packed day of insights. If you don't know who is speaking right now, of course, this is your host for the rest of the day, Jeremiah, and also we have Alex from MarketWise Asia. Alex, do you want to do a quick?
So a very good morning to you, ladies and gentlemen, traders and investors. I'm Alex from MarketWise Asia, and we'll be very happy to be your host for this today full day event. And of course, a very big thank you to our sponsor IG, okay, a MAS licensed CFD broker in Singapore for making this event totally possible over here. So just now, the first speaker was Brian Shannon. He talk a lot about on the anchor VWAP and the moving averages as well. And so this session, Manish should be talking about the moving average, and this will be a very good follow-up, okay, on moving averages. Okay, back to you, Jeremiah.
All right, perfect. So one thing again that we like to do here at Market Insights is to actually get everyone to engage with us. So if you guys are hearing both Alex and myself well, just put and type an OK button in, OK in the chat. Make sure that you're sending it not to just the panelists, but to everyone. Actually, this is going to be important for a productive discussion towards the end of the session where we have our question and answer. So I see a lot of people. Vincent, morning, welcome to our event. So we have hopefully a few others as well. If you can just type OK so that we know that you are there.
If this is your first session for today, maybe you can just type 1 in the chat box, or you missed the first session just now by Brian Shannon. It is okay. We have more speakers, more lineup, more strategies, more content for you. Can see that some of you, these are the first session for today. Okay, fantastic. Once again, a very good morning to you guys. Okay, like William, Herman, Cheng, okay, Vince. Okay, so more content for you later.
All right, perfect. So with that, let's get straight into it. So of course, as you guys have seen, this is the Market Insights Trading Festival, proudly supported by IG, our event sponsor, happening today on the 15th of July. We also have an upcoming event on the 29th of July that I will talk about very, very shortly, all right? First thing to talk about is the social channels. So we here at MarketWise, we also like to engage in building a community. And this is where we use different social channels like Facebook, Telegram, as well as Twitter. If you don't know, our Telegram group has already hit more than 6,000, and we are very excited to continue growing that channel. Now, what is it in store for you when you join these channels is that you can be updated with the latest event updates, with even market updates as well, which Alex actually does every single Friday, right?
Yes, that's right. So I already posted the link in the chat box. And just to answer Brian's question, right, will there be recording for the first session that I missed from Brian Shannon? Yes, and there will be recording, but of course, live session is the best experience that you have. But we have a recording, so 7 days after the event. So for the recording, okay, for the replay. And yes, every Friday evening, I will tend to do the live stream on the Facebook and also on YouTube, where I post my market analysis, outlook, and some of the trade ideas as well. So do subscribe to the Facebook, Telegram, Twitter. Twitter is where I share a lot of other trade ideas that I don't post on Facebook and Telegram as well. And of course, our YouTube channel where I live stream. So it is important that you follow, subscribe, and like our various social media channels. So once again, I'll post the link in the chat box.
That's right. And we also, on top of these channels, have YouTube as well. We started our YouTube channel quite a while back. And if you go and check it out, there's actually a lot of very useful content on our YouTube channel as well. If you ask me, video is always the most engaging form of digital media. So I think being able to kind of follow someone and also watch content that can actually educate and help you with your own strategies is very, very useful. So I also do encourage everyone to subscribe to our YouTube channel as well, right? Okay, so the next one is, so of course, working together with IG, we actually have a couple of very interesting collaboration that we've actually done up for you guys in terms of the promotions. Manish, of course, who will be speaking later, is also from IG. One thing that I want to kind of give a plug or shout out here is that if you're actually new to IG and you open an account with IG, and that's all you need to do, just open the account, you actually will receive a copy of the seasonal Vantage FX report that's worth $48. Now, if you want to take it a little bit further, there's some additional items that you can do to actually get some additional perks and rewards. So let me go ahead and share that with you right now. So if you actually go to our virtual booth, so on our landing page, you can click on the top tab that says virtual booth. You will actually be able to find all of the information about our promotions together with IG. So first of all, as I mentioned, as long as you open an account with IG using the same email address that you have used to sign up for MarketWise Insights, you will already get a free seasonal Vantage FX report. But if you take that one step further, if you create your account by the 31st of August and make a one-time deposit of $5,000 Singapore dollars, and if you start trading by at least placing one CFD trade during the promotional period, what you can do is actually get 288 Singapore dollars, and you can also earn Chris Flyer miles, all right? And if that's not enough for you, you can actually take that one step further and also receive an Apple Watch Series 7 or Apple AirPods Pro. And all you need to do here is to open the account and on top of the bonus, which is the $288 of cash, the top 3 participants who place highest notional traded value during this particular period will actually walk away with either the Apple Watch or the AirPods. Is that right, Alex?
Yes, that's right. And just to reinforce on the seasonal Vantage report, okay, this is really exclusive. I've never released this report before. And, you know, for those who know, okay, IG, it is the CFD broker. You can trade a lot of asset classes on IG, you know, on stocks, equities, forex, commodities, indices as well. So for those who don't know what is seasonality, seasonality is the tendency for certain securities, you know, to go up or to go down. And it is kind of recurring, you know, every single year. So you're doing a high probability trade over here. And these reports enables you to give you the insights on whether certain, you know, forex pairs, you know, are going up or going down in the month of August. And knowing this data, okay, whether this will help in your trading a lot, okay, I think you know the answer, okay. So yeah, so for regarding the seasonal Vantage, right, you do not have to fund any amount. Just register an account, open an account with IG, and you get access to this free report. Okay, all right.
All right. So with that, one last thing I want to talk about is the upcoming events that we have with MarketWise. So of course, happening on the 29th of July is an in-person event. This is kind of the second half of the IG Market Insights Trading Festival. This is going to be in person, held in Singapore at Suntec City. We are, if you guys have not registered for it, I highly encourage that you register for it. Depending on if seats are available, we'll definitely get back to you with more information. All right, we're really excited to see everyone in person in Singapore at Suntec City, all right?
Yeah, this is only for, sorry, just to interrupt, this is only for people residing in Singapore, okay? So please register only if you are in Singapore and able to attend the session, because we are already running, you know, short of capacity really. In fact, it is sold out. So we asked Suntec to open up more spaces for you. So please register only if you are residing in Singapore. And once again, it is free, just register if you can make it. Really happy to see you guys there on the 29th of July.
Right. Last but not least is our upcoming event in for Q4, actually the last lap of 2023, happening on October the 22nd and also the 21st. Is the Market Insights Virtual Summit. So this, I would highly encourage that you register for it right now as well, because by registering, you actually get access to some of the exclusive material leading up to the event, right, Alex?
Yes, that's right. So it's like, for example, for this event, you get exclusive access to Rainer Teo, you know, trading breakout system over here. And for the Market Insights Virtual Summit for the October session, you also get bonus material. All you have to do is just to pre-register for this event. You know, once we get the materials ready, we will send to you guys. Okay, but of course, we need your email address so we know where to send to. Okay, I'll post the link in the chat box already. So do register for this free event as well and pre-register for it.
All right, and with that, let's jump into our session proper. So, as we've mentioned, Manish, who is actually a market strategist at IG Asia, will be delivering this upcoming topic. And a little bit of information about Manish. Manish has over 20 years of experience in identifying market opportunities across different time frames, and also 14 years of experience as an investment strategist at private banks in Singapore. Now, Manish joined IG Asia in Singapore and began contributing to actually daily FX back in 2022. And today he'll be talking about choosing the right moving average for trading success. And so with that, we're going to pass the time over to Manish. Manish, we're really excited to get started with your session, and the floor is yours.
Thank you, Jeremiah, and thank you, Alex, for the kind introduction. And a very good morning to everybody. Thank you for taking time on a Saturday for this event. Okay, so at IG, our pursuit is to empower financial freedom for our customers. And I thought this initiative is a step in that direction. So what I've tried to do in this presentation is to take you through a strategy that has worked well for me. I use it quite a lot. And it helps you in identifying low risk, high reward opportunities across timeframes and across markets. The other thing is that it's an end-to-end strategy. So like, for example, we go to Amazon. In the early days, grocery was one, meat was something, vegetables was something, and then, kitchen appliances, etc. was separate. And then we have to organize delivery or we have to go personally. But nowadays, Amazon, it's end to end, right from the time you shop, everything you can buy and, it gets delivered to your doorstep. It's just like an end to end. So this particular presentation also is in line with that it starts with identifying an appropriate moving average, and then how to use that to convert it into a trading strategy right till the time of execution and also implementation of that strategy. So that's, without further ado, just a bit of disclaimer. This is purely an educational presentation. It's not meant to be any trading advice or any investment advice per se. In fact, the charts also are, almost all of them are dated charts and not current charts, because the idea is we want to find those appropriate setups. So this is what the menu looks like today. Let's start with the first aspect. So why moving averages? What's the use of a moving average or any tool for that matter? So purely, if you just use price per se and not overlay anything on that, it's just like using unprocessed food, and it can be sometimes very noisy, or it can be sometimes, very small bars, or it could be like just a small sideways price action. But if we use any indicator, or if we use a tool, or if we use calculations from the price, it helps you to package and process the price data so that we can reduce the noise element. It helps us filter the noise from a trend, depending on which indicator we are using. So that's the advantage of using an indicator or using an average. Now, an average is basically just a set of number, like, the previous speaker also explained to us. So how does it help in that sense? So for example, if there is a footballer X, and if the footballer has scored like 1 goal in every match for the last 15 matches, the probability is high that in the next match also, he or she will be able to score 1 more goal, or 1 goal at least. So a moving average represents a set of numbers and also gives us an estimate of where price will be or where the trend will be. So that's the advantage of using an average. Now, if I just use an average from, say, 1950, the average will be here and maybe price will be here. It will be meaningless to infer anything from that average because it's just too far away from where the price is. So hence, I need to take a role, maybe looking at the past few days, past few weeks, past few hours, or maybe past few months, depending on which time frame I'm using. So a role applied to a moving average really helps in to capture the most recent price action so that we can take informed decisions based on that. And MAs or moving averages not only give us a sense of the trend, but also help us in support resistance. And also, as we see later, it helps us in coming up with a strategy. So now let's just take an example. So supposing we are, just faced with this chart, as we talked about in the first point earlier, that what if we don't have anything? And what if we have that fall, that big fall that is towards the end of the chart? If we were to assess, okay, what is the trend over there in the middle of it? Now, in hindsight, of course, we know what it is, but in the middle of it, and when you see those big bars, big black bars with headlines in newspapers, it's a bear market, and people expect further fall. We are already preoccupied with a lot of information that is fed to us, plus our own emotions. So at that point in time, we may not be able to really filter between what the trend is or what we think the trend is and what others think the trend is. So it's a mix of all these things that come into play. But so it's quite possible that we may be carried away by that, and we may see that, okay, maybe the trend is really down and it's the bear market now. The other thing is, as we see, that there is no, let me just get a pen. So there is no identifiable support. These are just price supports or price pivots. These are just small pivots. These are not like a significant pivot like here or here that will help us in, at least identifying a price pivot or a support point, based on which we can take an assessment that, okay, if it's broken that support, then maybe the market is bearish. But over here, in such cases where it's difficult to identify a proper support, in that case, it becomes difficult to see what the trend is. So hence, if we overlay just a 200-day or even a 50-day or any moving average, at least it helps us. The slope of a moving average helps us in identify what the trend is, i.e., if the slope is up, then it signifies that the trend is up. And hence, at that point in time, at least it helps us in filtering. Now, I may take a decision based on that. That's a different point. But at least to identify or answer my question, is the trend up or down? It helps me in identify or in answering that question. Yes, based on this average, the trend is up. Based on this time frame, the trend is up. So moving averages help us in debiasing, making our investment decision, making our assessment of the market emotionless in that sense. So then the question comes, how do I go about selecting an average? Now, if we see that the 3-day, too short a moving average like the 3-day makes it too sensitive and is prone to whipsaws, and too far a moving average gives me a sense of broader trend direction, but may not be really helpful in coming up with a trading strategy around that. If I'm really trading, very frequently compared to a 200-day moving average, which could come, once in a few weeks or maybe once in a few months also. So I need to find an average which is not too sensitive, which is prone to capturing noise, and too insensitive that misses the gyrations, or at least the week-to-week gyrations of that market. So that's the idea, to find out what is an appropriate average. So when I started off, it was a bit of struggle to me, which is an appropriate average. Does it differ from market to market? Does it differ from time frame to time frame? How do I go about? And like we saw, anything below 5 days just becomes nothing but just a mirror of price. We might as well not have any average. But what I noticed is that anything, say, greater than 5 or 6 to about 10 to 12, that window is able to capture most of the price action by and large. So as we see, as the arrow suggests, that in that entire trend from June, and this is a 4-hourly chart. So from a 4-hourly chart, from this June all the way towards, say, maybe for a month or so, it was only once that we saw price closing below the 10 period moving average. By and large, it provided a very good support and bounced off also from that. And it also provided us a good sense of the trend, of what the trend is. So it's, whether we use it on a hourly time frame, an intraday time frame, a daily time frame, whether we use currencies or indices. So notice over here also how many instances that the market has rebounded. This was one instance where it's closed below, and all along again. Over here also no close below, no close above. This was close above, and then the trend changed, and then we had only one close below, and mostly all the closes were. Likewise, after we went down, no close above until the trend actually changed. So by and large, whether we use for a currency, whether we use on a daily, this is a weekly chart. Similar stories. Now again, one can use an 11-day, one can use a 9-day. It really doesn't matter. As long as you are in that window of anywhere from 5 to 6 to like 10, 12, around that average. I found 10 is something that is most comfortable to me. So it's, again, what our mindset is, what we are really seeking to achieve from that. So for me, 10 has really worked. I'm sharing with you something that I use on a day-to-day. And even if you look, all my charts that are set up, it's all 10 and 30 days. So that's what I'm sharing with you, what I follow. Likewise, monthly also, notice. So whether this entire downtrend, no close, and it just touched and bounced, it tends to hug and then go, hug and then go, hug and then go. This is what we want. That it could be why it's important, because that can give us sense of, it enables us to take an investment or a trading decision based on that once it's near in that window. We look for reversal signals. We look for some other overlay with other aspects to come up with a trading strategy. So again, likewise, whether it's, a sharp trend lower and all along, over a period of time. Now, there will be instances where it will not work, and we'll come to the end also. In the last section covers when it doesn't work. So we need to be aware that no strategy works all the time. Why? Because market is very dynamic, but a strategy is very static. So strategy will work in certain conditions, but will not be working in all conditions. So hence, that's why the need to have, stop losses, that why I need to have a proper risk management based on that. And also recognizing that it's not going to work in these circumstances. If we know that it's not going to work in these circumstances, at least we can take corrective action or the next course of action when we know it's not going to work in these. Likewise, quarterly, hardly something that we use. I tend to use quarterlies at the end of every quarter. Like, June quarter was just recently, just to get a sense. We don't use it on a day-to-day basis, but it's at the end of a quarter, it just gives a sense of. But even on a quarterly basis, as we see, there was hardly any close below besides, the COVID, the 2022 sell-off that we saw. So 10-period average really works well. Now, if we combine that, one average may not be enough, but if we take a multiple of that, either we take, a double of that or a triple of that, I found that if we take a double of that, it just becomes too small a window for trading. I found that if I use 3 times, meaning a 30-day, it just gives me an added edge over that. And we see in subsequent slides how that edge comes. So the first one was, as we saw, the 10-day captures most of it. The 30-day helps me defining the broader trend. It also envelopes all the whipsaws that we saw in the 10 period. And when we combine the two, as we'll see in the next section, when we combine the two, we can get some very interesting insights out of that. So this is a monthly chart, and a 30-day period just captures all the. So like we saw earlier that, moving average captures the trend. So you see a slope of a moving average. Notice the slope. The slope is just all the way up until over here, at least the slope changed. It's all the way up. In fact, from GFC, this slope around here, 2009, 10, it started to turn up. And since then, it's only been up. The slope has only been up on a monthly chart. It's not trend. Why is it important? Because in these cases, when we are in real time, when we are really faced with that, and we may even see, news flow coming, or we may even see a break of a support or a pivot on a shorter time frame, sometimes we get carried away with that. So sometimes these zooming out pictures helps us in a proper assessment of what the clear trend is. And based on that, I can again take a proper appropriate action based on after I identify that. This is a weekly time frame. So, likewise, if I use a combination of 30 also, then most of it. So if, this is April, for example, and this is all the way 1 year. In 1 year, we just had, just one close below. More or less, it was all above. And, if we add the 30-day, at the 10 period moving average, it will give us some very interesting insights into that. So 30-day, whether it's a weekly or a monthly or a daily also, whether again, likewise, we saw indices, currencies, likewise, similar story, at least it helps. So like notice, once the trend changed all the way, notice the slope has not changed. The slope only changed over here once it was lower. And notice after that, the market just went sideways or slightly lower. So slopes of moving averages also help us. They tell us something about the trend. So just being vigilant and attentive to that helps us, at least avoids in taking the wrong step or the wrong trade in that at that point in time. Likewise, what about 4-hourly chart? This is a WTI crude chart. Same thing. Notice no close right from the time it started all the way, only when the trend changed to sideways and then the trend changed up. And notice no close all the way till the trend changed lower and then it went down. Of course, it's, it doesn't happen all the time that moving averages are always sloping. Sometimes it's sideways. And that's when, it may not work. Likewise, hourly chart. This is the gold chart on an hourly time frame. Very similar in terms of, identifying whether it's a support or a resistance. And as we saw in the first slide, also identifies a trend for us. So this is in a way, in a nutshell, what was as far as just identifying which is an appropriate moving average. So 10-day or anything, just to sum up so far what we've seen is anywhere between 5 to 6 to maybe 10 to 12, around that, you can select one and then take a multiple of that. Ideally, at least minimum or two, but ideally, I found in my experience, I found that a 3 times works very well. If you're using a 2, then MACD also does the same thing for you, which is nothing but a 12 period and a 26 period, slightly more than a double of it. Then in that case, MACD also will do the job for us. So in this case, I've just taken 10 out. So one is to use an appropriate moving to select an appropriate average, and more often than not, that will work for all time frames and across all all markets, and then taking a multiple of that. Now let's combine the two, and now let's see that how it works. So when we combine the two, it helps us not only in the trend of in case of trend assessment. So notice over here, this was April 22, almost a year and a half. Price closed below this only just 9 times. And we are talking about a 1.5 year time frame on a daily time frame. So in those circumstances, price closed below that. But we are just using only these 2 averages. We are not overlaying that with any other indicator. We are not also looking at price pivots in that sense, just purely based on that. If we combine that with price pivots, then we'll have even better assessment of whether the trend is actually changing or not. But let's stick with right now only the 10 period and the 30 period. So that was S&P daily. What about NASDAQ weekly? Similarly, so again, look at the slopes. First, look at the slopes. Look at the support levels and how it's rebounded from there. Why we are again and again insisting on support, resistance, rebound, because that's what our trading setup is going to be like, and which is the next section that we will. So pardon me for repeating again and again, and focusing on the support and resistance, because it's important to remind ourselves, because that will be helpful later on. It's a stepping stone for our next section and how we make that strategy. I'm going particularly fast in this one because I want to go slower in the strategy part, which is the real cream, the real important stuff, which will help us in making us independent. This entire strategy will make you independent on your own. You will not need any help except for a chart help to make your trading decision at any point in time. So anyway, so let's just quickly go through just the basics. So this is NASDAQ. And so whether we are looking at a weekly time frame, a daily time frame, a monthly or intraday time frame, the story will be similar. Now let's come to the crux of it, that how do I use it? Okay, I've seen how it's used for support, resistance, and also for trend. But that's not enough to make a trade, right? It's helping us. A trend is identification of, this helps me in knowing what trend is. Okay, so if it's up, so what do I do about it? So now let's take that step further. How do we use this? What do I do about these 2 averages so that I can identify a trade setup? I'm going to go particularly slow over here because this is finding high probability setup or a low risk setup. This helps us in finding a low risk setup. Again, across any time frame, across any market, this strategy will work. And that's why we've taken examples which are across these time frames and markets. So let's take it step by step now. So again, just repeat myself, we've taken the 10-period exponential moving average, the 30-period exponential moving average. PMA is just period because the period may vary whether it's a daily time frame or a weekly time frame or an hourly time frame. So to what we saw earlier, 10-period, which is the 10-period exponential moving average, and 30-period exponential moving. Okay, let's take the first step now. In an uptrend, wait for a retreat. So this strategy is not about following a trend. This strategy is not about a breakout of a trend. That may be a different strategy. This is not about that. In this period, in this strategy, it helps us to identify entry opportunities in a pullback, or if it's a downtrend, in a rebound, in a downtrend. So these are capturing pullbacks in an uptrend or retracements or rebounds in a downtrend. So wait for a retreat. This is not about getting or trend following or moving in the way the market is moving. No, we have to wait for a retreat. So this is our retreat setup. This is what the retreat is when it happens. Okay, so one, that's the first thing, wait for a retreat. Next, what is an uptrend? Now, uptrend constitutes one where the shorter moving average is above the longer, which is the 10-period above the 30-period. It can also imply upward sloping moving averages and also wider gaps between moving averages. So all these constitute what signifies an uptrend. So as long as the first filter for us is to see if the 10-period is above 30, okay, the trend is up. The comfort level will increase as you go on, looking at this setup, as your eyes get used to this setup. First, there will be, in my experience, when I started with this, it took an effort to identify, oh, okay, is it a uptrend? Is it above, below? Then it, took an effort to find out that retreat. But once I notice that I do it again and again, my eyes get trained. Then it just, comes in naturally, and, it doesn't take so much time to go step by step from 1 to 3. But of course, I had to go through that setup of 1 to 3. So first is to wait in an uptrend, wait for a retreat. Second, for an uptrend, the 10-day has to be above 30-day. And the greater the slope and the greater the width, the more comfortable we will get. We will explain this point as we go along in the subsequent examples. So firstly, the first point is to wait for a retreat. The second is shorter has to be above the longer. The third condition is price must be, this is a very important must, be between the two averages for the setup to be valid. What does this mean? What this means is that I will avoid all these, even though there is a retreat. Sorry, not meant for me. At the same time, I will avoid every dip which is below the 30. So avoid all retreats which are above the 10-day or the 10-period, and avoid all retreats which are below the 30. I want to avoid, no matter how convincing it looks. I'm fine with that. I can let that go. And we will see why later on, that sometimes they give you false signals. But what I found is the risk in that opportunity tends to be low when the price is actually in between the two averages. So avoid everything that is in above the 10-day or below the 30-day. So that's the third condition over here. So that leaves us with this gray box. That over here, firstly, let's do step by step. Again, I'm sorry if I'm going to repeat, but repeating, I feel that always helps. So first, 10-day crossed over here. So here, the 10-day is above the 30. So our first condition is satisfied. The second condition is satisfied. The first condition is wait for a retreat. So this is a retreat that has taken place. And the third condition is price must be in between. So now we are faced with this, that all three conditions are satisfied over here, i.e. crossover has happened, which is 10-day above the 30, retreat has taken place, and third, price is in between two. Okay, Now I have it over here. Now what do I do? What is the next step over here? So next step, wait for price to show, which is the fourth point, wait for price to show some sort of a reversal. Now it could be a candle, may not necessarily be, but sometimes it could be a candle. In this case, it is a doji candle, which is a doji candle over here. This is that doji candle over here. Wait for some sort of a retreat. Wait for price to stop falling. If it would have fallen, then price would have come over here like this. Then sorry, it's not meant for me because price is below 30-day. I don't want to look at it. It's not my setup at all. Maybe some other setup will work, but not this setup. So I ignore that. If price stops falling, and if the market gives us something like a reversal kind of a candle, which is a doji in this case, then I'm on high alert. On that day, so I get sufficient time. So this over here, sorry, not meant for me because price is still falling. On this bar, I become alert. And again, this is all closing. So it's not like, real time. This is on closing. At the close of market over here, I realize, aha, okay, there is a doji signal over here. Price is in between. My setup is activated now. I need to be vigilant now because now I need to wait. I need to now watch for the entry point or whether the market is willing to give me that entry point. Now, till such time, I don't know it's going to be entry or not. Why? Because after this doji, the market may still fall. Then in that case, sorry, it's not meant for us. But on this bar, I will be completely vigilant that, okay, let me be on the lookout. The next day when I'm getting in, open my laptop and see, okay, price did doji yesterday. Today, let me be on high alert. What is that alert? That if the next bar, which is the blue bar, if the market rises above the high of the previous bar, it's my entry signal. I repeat, consider longs, which is number 5 over here. Consider longs on a rise above the high of the previous bar. Which is the previous bar? The previous bar is this doji. If the market today, or in the current time frame, or in the current hour, or in the current 4-hour chart, or in the current weekly chart, if it rises above the high of the previous bar, it is my long signal. I go and execute that trade. What is the risk reward then? The stop loss is the low of the previous bar, or I can keep it slightly lower also, depending on what my comfort is. So as you see, it's a low risk entry. The risk is not so much that I'm taking. I don't have to take a few bars of risk. I only have to take 1 bar risk, depending on which time frame I'm looking at. So it's just 1 bar risk that I'm taking. So I take the low of that previous bar. This is my stop loss. What is the risk reward? The risk reward is either I set 1:1. I can set a few, at least about 2 or 3 bars, subsequent bars from the time that I got the entry. Assume I leave out this bar. I can at least get about 2 bars from there as target. It can also be a previous high point, or it could be this previous high point. Invariably, what I have found in my trading, the market usually gives me more than the 1:1. But on a realistic and just keeping the discipline, 1:1 works most of the times. So again, let's go through the setup. We have time. Let's just go through the setup once again, just to make it very clear. And I'll take the next example on this one. So again, just to repeat, let's take, this is natural gas daily continuous, same thing. Firstly, our first condition that the 10-day has to be above the 30-day condition satisfied over here. Okay, slopes are trading up and, the moving averages are trading up. And now we wait for a retreat. So we wait for a retreat. So the first one was, the close was in between. One can also say, sorry, I'm not interested in this. It was slightly below, so I'm not sure about that. So I can leave that out. I can take this one, where price is in between. Pardon me, because I've shrunk this in one, chart. That's why the bars are looking smaller. But if I zoom out, it will be clear. So the setup is over here that, okay, I wait for a retreat. So point number 1, point number 2, point number 3 satisfied. Point number 4, I need to wait for at least some sort of a reversal candle. So over here, in this case, it's like a bullish hammer pattern. Price is in between the 2 averages. And the price has given me a reversal, a hammer pattern. On this day, the next morning when I wake up, see the laptop, okay, My setup is now activated. Now I just need a confirmation. Today's bar will give me a confirmation whether it's buy or not. So on today's bar, once it rises above the high of the previous bar, which is yesterday's bar, my setup is active, my trade is active now. I go and I execute that trade. Once I execute my trade, what is my stop loss in this case? My stop loss over here is the previous bar, low of the previous bar, or I can set it slightly lower. What is the target? Target can be 1:1 or the previous high, or minimum 2 or 3 bars, which will be quite clearly in more than 70% of the cases, more than 1:1. So what we saw earlier is that one, assuming we leave this out and we take this one, we execute in this one. Similar setup over here, price was in between, same thing, we got a reversal over here. We ignore this because price was below, so leave this out. Notice over here, nice doji pattern, classic pattern, price fell, doji pattern. Subsequent day, we got a high above the previous bar. Crossing of the previous high of the previous bar was an entry signal for me. I set my stop over here. Entry, the risk reward can be at least 1:1 from my entry point, okay? 1:1 from my entry point, because it's quite possible that the market really moves. Maybe I'm not there on my desk to see that. Maybe it may not be exactly 2 or 3 pips. Maybe it could be 10 pips above the high of the previous bar. Assuming where I enter, I'm taking 1:1 from my entry point. But as we saw earlier, it's most cases, it will be at least the previous high, or it could be 2 or 3 bars. This is 2 bars, it got the previous high. So likewise, also over here, same thing happened. In this case, 2 bars, but it didn't come across all the way towards the previous high, which is a point we'll consider at the end of the presentation when it doesn't work. So this is an important point to remember. We will revisit that, why it didn't work at this point in time. So we will revisit over here. But we want to ignore this one because this is below this. Sorry, we're not interested. This one we'll ignore. Sorry, we're not interested because it is below the 30 days. So we will only take these setups where it is in between. Sorry, we'll ignore this, where it is in between the moving averages. So even if I'm looking at a few months, this is a daily time frame, I was able to at least identify, or the setup was at least able to identify a few low risk entry opportunities. I'm much more comfortable buying a dip rather than buying at the high, because at least I know I'm not buying at the high. For me, psychologically, it just works well that I don't want to be the last man standing, if at all this is a reversal. What if I'm buying at the highest and subsequently the market falls? I'm a lot more comfortable after I know the price has retreated, which is what this setup does, that at least I'm not buying at the previous high. I'm comfortable with that. So that's another thing. Again, this can also be used for someone who wants to do buy and hold. That, okay, I don't want to buy at the highest price. I want to buy on a retreat. And maybe you will not choose to exit over here. Maybe you will just, hold it. Especially if my weekly and the monthly or the quarterly time frame shows uptrending slopes or moving averages, which I know that the trend is up. In that case, I just want to use this as a buy and hold. Sure, no problem. We can also use this as a buy and hold. So there are multiple ways in which we can use it. Likewise, whether it's different markets. So this is silver an example. So notice over here, the first time, what I found is the probability tends to be very high of that trade working the first time a dip or a rebound takes place after the trend has changed. Second time also, more often than not, it works, but the probability is the highest in the first time. Second, third time, it tends to reduce, but it's still there. It doesn't mean that it's over. And that's where the width of the moving average comes into play. So let's explore this point a bit further. So first, the probability tends to be highest the first time. So the crossover or the trend changed over here. All along over here, the trend was 10-day above the 30. Over here, it changed the above. It changed the trend changed where the 10-day was below. So in this case, the trend is below. In this case, the probability is highest when the first time a rebound takes place. How can I use this particular aspect? Well, 2 or 3 things we can use it. One, I can allocate a slightly higher capital when this condition comes up for the first time after the trend has changed. One. Secondly, I can make sure that I don't miss out on that. If I miss out on the second or third time or fourth, fifth time, it's fine. I'm fine. But I need to make sure that I don't miss out on the first time something like this takes up. And we'll see examples also where only once it's worked and it's not worked on subsequent times. So this is in a case of a downtrend. We'll also see the next section also takes into consideration in the downtrend. But notice over here, again, coming back to the uptrend, notice over here, crossover is taken down. This is the first dip we have come across. Price is closed in between the two averages. So this setup is now live. Now, this also is an important thing. Why? Because the reversal didn't take place in the very next bar. It took one more bar to take place, but the setup was activated over here. Setup activated, condition satisfied, 2 or 3 bars, previous high easily met the target. In fact, after that, it actually pulled back. But even if I don't have to wait for the 2 or 3 bars, 1:1 risk reward is satisfied over here. Likewise, this is the first dip that has taken place. First dip, no problem, probability tends to be high. It's a very low risk setup. So for those who are very risk averse, for those who are really getting into trading for the first time or getting, few instances where we've not had so much luck, then this could be something for them that, okay, let's just start off with only the first time it takes place. We'll ignore all the others. Why? Because I want to build confidence. What I found is when I started off is that initially my decisions were gut feeling, or what CNBC or one of the news channels says, or what the newspapers or says. So I used to go by that. My decision used to be biased by what I'm hearing or what I'm reading, or but there was no system as such. So I did that. Sometimes it worked, sometimes it didn't work. But what I noticed is that when it didn't work, yeah, I lost money. That's fine. But with money, I also lost confidence. And once I had 5-day trades in a row which didn't work, my confidence was not just 5 times lower. It was almost gone, almost 100% gone. Then to make the 6th trade was like crossing a huge hurdle for me. So what I realized that my confidence took a very big hit. And to gain that confidence back was a task. So that made me realize, listen, I think it's important to have a system. Having a system at least debiases my emotions from it. At least it helps me in giving only that much respect. I'm not saying we don't respect what commentary is being served, what news channels or analysts. Yes, they all have a place. They are all important. They deserve as much respect. But what I found is that undue respect to my emotions was giving me trouble as far as my confidence was concerned. So I said, okay, I want to minimize that emotion. I want to minimize what others are saying. I'll take it as one of the inputs. What I'm reading, what I'm grasping, what others are saying. It's one of the input, not the input. So I needed to find a system which I have to rely on, fall back on. No matter what I've heard from everywhere, what I've seen and read everywhere, I need to rely back on my system. What does the system say? That made me realize how important a system is. From that point in onwards, I started looking at systems in that say, or frameworks or models or algorithms. I went ahead and identified trend following, breakout system. This is a retreat in a pullback. How do you capture big trends? How do you capture? And I went on to learn coding on my own. I coded all of them. Finally, I went into also learning Python and then supervised machine learning also, because I thought it will help me in my decision and, in terms of my journey as far as having as much as systematic as possible. Again, also just blindly and systematic, I must know where it doesn't work, just so that I know conditions where it works and where it doesn't work. So that's why it's important for those who don't have or have not been or just started the journey or in the process of identifying setups or systematic ways to trade or low risk opportunities, this could be one. And that's why the first dip is almost always a good entry point I've come across. Even when you have just a sharp rise. So in this case, it's a sharp rise. Notice this was just like one or two opportunities, and then subsequently price just turned lower. This we're not interested because price was below 30-day. I'm not interested in that. So sometimes you get one, even if it's like just a sharp rally, but you will still get one opportunity, that one opportunity which will get it previous, the previous high, whether it's this high, whether it's the previous high. So the first opportunity tends to be a low risk opportunity. So something you've not tried before, then maybe just look for that first dip, leave the others, and that way look at various markets, look at various time frames that will give you an at least frequent opportunities to trade. Likewise, this is a setup in a downtrend. Let's quickly just go through again, just so that we don't confuse ourselves with the uptrend. In the case of a downtrend, clearly we have to wait for a rebound. We have to wait for a rebound. So that's clearly. We ignore price, which is like above. We ignore price, which is below the 10-day or the 10-period moving average. We all ignore all of this price action because it's all taking place below the 10-day moving average or 10-period moving average. What is a downtrend? In a downtrend, what happens is that the 10 period is below the 30 period. Again, like I said, if we are new to this, it may take a little bit of time to train the eye for that. But once you start doing it more and more, the eyes will get trained. And my apologies, I forgot to say earlier, if you are already familiar with moving averages, if you're already familiar with a similar strategy, my apologies if I'm repeating this for you. I am really grateful to you that you are even listening to me, even though it may sound very familiar to you. So my apologies if you're already familiar with this. But also, it's just for those who are also not familiar, and maybe we'll take it just as a revision in that case. Okay, so in a downtrend, shorter moving average is below the longer moving average, so 10 period below 30 period. Same thing, downward sloping moving averages and gap. So what I noticed is that when the gap is very high, the market will give you 2 or 3, 4, 5 opportunities. That's why we included widening over here, that the wider the gap, the more the opportunity that you will have to trade. So even though you may not be settled for just one, if the gap is too wide, you can get second, third, fourth, fifth, sixth, and several other opportunities. But if the gap between two averages is very narrow, then you may not get recurring opportunities in that time frame and in that market. Next, the third is very important. Price must be between the two. Ignore everything above and ignore everything below. It gets activated only when price is in between this case. Okay, what about the setup again? Let's again revise the setup on a downtrend. So in this case, what happened is price came over here. On this bar, I am on, it's a red flag that, okay, it's come in between. Maybe it might give me a setup, maybe not, we'll see. Let's wait for the next bar. On the next bar, it gives me a hanging pattern. A hanging bar, a hanging man candlestick pattern, which is this one, in like a hammer in a round trend. Okay, so I've got some sort of a reversal candle over here. So the strategy is now activated. Now I need a confirmation. All this while, there is no confirmation, I repeat. All this while, even after we get that reversal candle, it is not a confirmation. Why? Because price can still rise. It can still happen. So it's not a confirmation. It is only a setup warning. It's not a confirmation. The confirmation will come when price will fall below the low of this bar. Once I see a low below this bar, that's my confirmation. That's when I hit. In that case, what is my stop? My stop is the high of the previous bar. Notice how low risk the entry is, just not even one full bar. It's just that previous. And more often than not, if it is a reversal candle, more often than not, you will have a small bar. It will not be like a huge bar, which means the risk is very huge. Another thing, if you are new to this setup, if you see that the bar is too big, that reversal candle, which is a hanging man or a hammer pattern running, if it's too big, avoid it. Don't get into high risk setup to begin with. The market will give you several opportunities like that. So if it is a low bar, if it's a small bar, a small trading range, it's also an indication that it's a low risk and high chance that you might get a reversal, you might get a confirmation in the next bar. What is the target? Target could be either this previous low, which was hit, or at least about 2 or 3 bars, or 1:1, or you can use it for a buy and hold and not just exit from there. Why buy and hold? Because if the gap is too wide, then it means that the trend is getting more established. So sometimes it will also give you an investment opportunity and not just a trading opportunity. It will give you a chance of a swing trade and not just an intra-week or an intraday trade. It can also give you a positional trade, a multi-day, multi-week time frame in that sense. So this is what happens in a downtrend. Now notice, why have we chosen the high of the previous bar in the downtrend and the low of the previous bar in an uptrend? Notice, sell down. Say, for example, I got into here. So over here, let's take for this example. Over here, let's start from here. First, on this candle, I'm activated. Why? Because price is now in between. All these, even though they may satisfy 4, 5, 6 conditions that we saw earlier, but they are meaningless because price didn't come to that in between the average. So in this case, my setup, I get a red flag that price is now coming in between. Aha, okay. Price is now coming between. I get warm up to that signal, to that setup. What happens in the next bar? In the next bar, there is no, yes, it's one can say it's a small bar pattern, not exactly a doji, but can be classified because it reflects an indecision because it closed in between. But it didn't go below my previous low. So activated, but not confirmed. Okay, let me go in this bar. Okay, it's also some sort of a reversal candle, but hello, it made a new high, it didn't make a new low. So again, activated, but not confirmed. So you will have cases where we may have to wait for a few bars for that formation to form. Same thing, very range price action, same thing, same thing. Now over here, it gets activated. So over here, the condition is activated. This is my stop loss over here. Now let's take a case where, okay, I got into, let's take realistically, I got in at the low of this. Because I was out that day, I was in a meeting and I was not able to capture, just 10 pips or 15 pips above this particular low of this bar. So maybe I got into the low over this bar. On this bar, I see a reversal, but my target is not met yet. And maybe the market could rebound over there. Fine, that's fine. But notice, it's still, even though it rebounded, still don't break the high of the previous bar. That's why in the first slide, we saw that maybe keep a bit more cushion over here. Maybe give it a few more pips, not exactly at that low. If you want additional cushion, because sometimes, what feed or what, because of these algorithms, sometimes the exact level, the last pip of that support may not necessarily hold. Maybe it's 1 or 2 pips above, maybe 1 or 2 pips lower because of the way the price is struck. So maybe give it a bit more cushion, maybe take a few more pips above that to give you a bit extra, breathing space in that trade. Gives you more time to stay in that trade because we just don't want to, get exited for the wrong reason. That just because we, got unlucky in that sense. But even then, notice that even then, the high of that previous bar, which is high of this bar, was not broken. And subsequently, our target also met. Supposing I missed out on this one, maybe I could have done either one more trade over here, either I could, especially if this is the weekly time frame. If my weekly time, this is a daily time frame, sorry. If my weekly time frame shows sloping down, if my monthly shows sloping down, then it gives me added comfort that, okay, I know that the broader trend is down. I know that on the 10 week is below the 30 week, the 10 month is below the 30 month. I know that the trend is down. Okay, even if I have to stay in the trade for longer, I'm prepared to stay there because I'm convinced at least the method, my system tells me that the trend is down on higher time frame charts. So in that case, notice that even then we are able to get not only 1:1, but we are able to get the previous low of that, or whether, the previous swing of that, ultimately it was able to get us. So likewise, these are various times when, this was the first time notice, first time again works, second time also worked, but third time price went above. So I ignore that. There was no opportunity after that. Maybe one can take this one if you want to. But again, I normally just keep it very disciplined, strict. I just take closes which are in between price action, which is in between the averages. There, like I said, in a downtrend or in an uptrend, you will get, the market gives us invariably several opportunities to trade. Likewise, this is another example, dollar CAD weekly. The first time the crossover took place, this was the first trade. Then again, subsequently, it gives us. So see, notice the width widened. And, there were other opportunities also. But again, coming back to us, the first time, normally, the risk reward tends to be highest. Again, first time, dollar yen, daily chart, dollar yen, first time, risk reward tends to be highest in the first time. And then subsequently also. But notice that at the end of a trend, sometimes your target may not be, which means that once you do it for a few times, as you say, do it like 3-4 times, as you go on in the same market, same time frame I'm talking about. If you've done it and it's worked for 2 or 3 times, 4 times, subsequently lower your capital or have much tighter stops. And once your stop gets trade, your trade gets stopped out, it is a warning sign that the trend is changing. When this setup doesn't work, it's also a warning sign that the moving averages might do the other way. In that case, I have to be watchful and for signs of a turnaround, a reversal of the trend. So let's take the last part as to when do these setups don't work. And then we'll open this for Q&A. Just like 2 or 3 more slides to see when it doesn't work. So we started off with identifying moving averages. Then we went on to identifying 2 moving averages because we need 2 to, it takes 2 to tango. It takes 2 averages to identify a trade setup which is relevant for us. What does this trade setup do? The trade setup that we identified helps us in catching dips in an uptrend or rebounds in a downtrend. Why? Because I don't want to be, psychologically, I'm more comfortable buying a dip rather than buying that last price. Or when the musical chair stops, I don't want to be the one with that. I don't want to be the one who's standing. So in that case, I want to at least identify a setup which is a retreat. Once that retreat takes place, I want to identify a setup where it's a low risk entry point or a high probability working point. Within that also, the first, maybe the second also, more often than not, I would say at least 70% of the times, first time will work. Second, third, fourth, depending on how strong the trend is, can work or not. Now, even in a choppy sideways condition, you might just sometimes get. So this was the first time. So you see, taking place over here, and the first dip takes over here. So the first time, even if you don't know, now hindsight, we know that this is a choppy sideways, but we don't know here when we are over here. Over here, maybe it looks like a reversal, right? So even then, the first time gives you an opportunity. You at least got back the previous bar. You at least got 2-3 bars. You at least got your risk reward. But we realize that later on, you see over here, the second time over here, it was not a very clear trade. So in a choppy sideways condition, you may have setups which are false setups which may not work, or setups which are not very clear enough. So it's important to identify that in a sideways condition, avoid it. So, okay, how do I know when the sideways condition is exited? So just simple, just go to the lowest point in that and go to the highest point in that. Don't trade in this time zone. Let me look elsewhere. Let me look at another market. Let me look at another time frame. I don't want to look at gold or hourly. I will look, if I am in love with gold, I will look at either a smaller time frame, half an hour time frame, or I may look at a time frame which is higher time frame. If at all I want to do the hourly time frame, I will only trade if price goes above this because it's a sign that the trend is changed, or price goes below this. So first is it will not work in a sideways chopping market condition. The second it may not work is when it's a straight line drop, where price don't even hug or don't even come in between. And this was like what, more than a 20% drop peak to trough. But I missed that opportunity. Why? Because the price drop was so sharp, it never came to the 10 period. Forget moving in between the two averages. It never even came to the 10-day period. In that case, it may not work. At such times, what happens? So look, notice over here, no chance at all, even though such a strong downtrend, but I just didn't get an opportunity to participate in this trend. When you have this, when you have cases, the first sign was when you have like repeated lows, which are big bars, and price goes away and away from the 10 period, sometimes opportunities are created on one smaller time frame. See, first opportunity after the crossover took place, 10 period below the 30 period, first opportunity was a good opportunity. After that, notice there was no other opportunity at all. You got this opportunity, but notice it was just about very shallow. What if you would have got in this bar, which was slippage? Then in that case, it's quite possible you would have got in over here in this bar, which meant that your target wouldn't have been fulfilled. So that's what I said earlier, that sometimes in the second and third, how advanced that market is already in the downtrend will determine whether the probability of that trade working out or not. But even then, at least it gave you one opportunity to participate in that trend. So that's the second thing, that sometimes when you have sharp moves, so that's why if you have 5 or 6 bars on the time frame, which are very, very away from even the 10-day, move to a smaller time frame to trade that market or to look for opportunities in this market, in that market. The next is at the end of a trend, and which you saw earlier in that earlier slide, at the end of a trend, it may not work. So notice over here that this was the time when it turned up. This was my first buying time. And notice that after, say, the reversal of this bar happened only in this bar. But notice I didn't get a chance to participate over here. We've not taken the previous price action because we don't know whether the previous was uptrend or downtrend. So I'm ignoring this, whether it's the first time or not. But what the point over here is that in a change of a trend, this strategy may not work. In a change of a trend from down to up, you will have several false signals. But even though you have such a sharp drop, at least one opportunity the market will give you. One opportunity at least, which could get you either to that 2 or 3 bars. It may get you to that bar, or it will at least give you that 1:1 risk reward. So at least one of the conditions it will definitely satisfy. But to give you recurring opportunities, it depends how strong the downtrend or the uptrend is. So in a market where one gets stopped out, and in the market where moving averages go sideways, so that was the first slide that we considered. The slope of a moving average also indicates whether the trend is not up or down. So in this case, notice the 10 period, 10 period, notice it's just gone sideways. Even though price came in between those two averages, there weren't very many opportunities, or even if there were opportunities, those were false opportunities. So, but even then, even before that, at least I got one opportunity to trade in this condition. So this was when conditions in markets where it doesn't work, but most of the times, notice, at least first time, maybe second time, but third time, notice it didn't work over here. In fact, the stop was at the very next day. That's when the trend is changing. So at such point in time, like I said earlier, first trade, one can be high capital. Second trade could be smaller than this one. But as you get 2 or 3 opportunities, reduce it as far as possible, or at least have a tight stop. So that we don't want our capital to be wiped off from things that we earned in the previous legs. It's only to protect ourselves. And also we know that subsequently the trend is beginning to change or not in that sense. So this is what I've had for you today. Very quickly to sum up before we just open it for Q&A, we started off how to identify moving average, why moving averages are important. It can give you it can serve several purposes, identifying a trend, identifying support resistance, and finally identifying a trade setup, a low risk trade setup. So coming back to where we started, the Amazon example, just by the 10 selection of 10 and 30, it took us all the way through in case right from end to end, identifying low risk reward, profit targets, and when to avoid opportunities. So that's what I meant. Normally, I may have one set of moving averages, but my trading setup would be something like different moving averages. And then I don't know which one worked and which one didn't work. This one, at least we know where it didn't work. Then I can take appropriate action. If the model needs to be fine-tuned, then yes, I'm very happy to fine-tune that model if I feel that in certain conditions, repeatedly, it's not worked when it could have been avoided. Then I may fine-tune that. That's fine. But if I have several things going on at the same time, then I don't know which one is working and which one is not working. And that's where I lose confidence, that repeated losses will make me lose confidence. Okay, I will pause over here and we can open for Q&A. I will just get I'll stop my screen so we can get the chat window, the Q&A window. If possible, let's put it up on the Q&A section so that we, we can all take them as we see along.
All right, so thank you, Manish, for your sharing on how to use the moving average and how to find the setup and also the trigger as well. As you guys can see over here, there are quite a few questions in the Q&A tab. Okay, so all right, you guys can also upvote those questions if you want Manish to answer them. It's this very pressing question, or you have new question. Okay, you can put it there. If you want, if you have the same question, you can upvote the question. So we'll answer those who have the most upvote first. Okay, all right. So maybe you can go through in order first.
Correct.
Tarun is asking, when you talk about closing, okay, is it like the 5 a.m. Singapore time, which is the New York closing? That's right. Okay,
correct.
Right?
Correct. So what happens is that supposing I'm selecting a say my chart. So for example, I may be based in London, I may be based in Singapore, I may be based in New York. So this is a very relevant question. Yes. So you're right that we can take 5 AM SG time as the New York closing because that's what is relevant to us if we are based in Singapore. But normally, if you set a particular time to that, so Reuters may have a closing, Bloomberg may have a closing, maybe TradingViewer may have a closing. So depending on what we have set, if it is by default, then more often than not, it will be the New York closing. But sometimes some softwares take like the GMT London closing also. But yes, to answer your question, yes, we can take that New York closing as the close of that. So the close of that particular bar could be. If it is an intraday, then it is the close of that hour. Now, sometimes it may not be exactly 12 o'clock, 4 o'clock. Sometimes it could be like 1 o'clock and then, 5 o'clock for. So depending on, we just have to go back the previous few bars to just look at what the software is set up to do. Based on that, we just go ahead. But we can surely tweak some of those settings in our system. But yes, you are right that we can take that New York closing as an example. If I'm using the daily chart, hourly chart, of course, will be very different. The second is that, yeah, correct, you are right. So it's, depending on which market I'm trading because volume is not available in that. Yeah. How to plot the 30 period and 10 period in a daily and a weekly chart. So the 30 period or the 10 period in a daily chart is nothing but the 10-day exponential moving average or the 30-day exponential moving average. In a weekly chart, it will be 10-week exponential moving average and a 30-week exponential moving average. So that's how it will be. These are very, so whether we are using TradingView or any of the others, Metastock or any other software that we are using or online platform we are using, exponential and simple will be very clearly identified over there. So we just have to go and select. By default, there will be some moving average, but just go and change it to 10 or 30 day in that sense. By all means, if you want to modify, if you feel that, this doesn't work, let me change it to 11 and, 33, by all means do it. I'm sharing something that has really worked well for me. I'm sharing something that really work for me even now. And by all means, please experiment. And, using the slide pack, as Alex mentioned earlier, will be available after 7 days. Use this as an example, go forward and, experiment by all means yourself. The idea is we want to be independent. This will make you independent in making your own trading decisions. You will not have to rely on anybody. And that's the advantage and the beauty of this. From anywhere, from a beach, from home, from a hotel, from anywhere you are, you can trade that any market that you're looking at. It will enable you. And once you do that, set it up as your default chart settings. So that even if you are bringing up any chart, this will be the default, because then your eyes will be very trained to be able to do that. Okay, let's move on to the next question. We have 5 more minutes to just...
maybe Manish, just to add on first. So, just like Manish mentioned already, so even for the IG platform, if you are on the daily time frame, IG will also show the daily moving average. So it is automatically on the daily moving average. If you're on a weekly chart, most likely you'll be on the weekly moving average. Okay. Yep. So I think from the Pat, okay, I think she said that you sometimes see you on trade on the weekly and sometimes you are on the daily time frame. How do we know, or when to select the best time frame to trade?
Okay, so that depends on Alex. First of all, thank you very much for jumping in, and please do. Alex, as everybody knows, is a very seasoned trader and been their markets for long. I follow him on YouTube.
Thank you.
Some of these setups and trade opportunities are just fantastic, especially the one recently he captured in the grains market was fantastic. So hats off to Alex. So Alex, please jump in also for Q&A. It's I'd love to have your inputs also, because we are all learning and it's just a perspective that we are sharing. So there's no right or wrong. So coming back to how do I know whether I select a daily or a weekly thing? So when I started off, as again, coming back to what Robert Miner says. So Robert Miner says, mind, method, and money management. These are 3 very important tick marks or checklists when I'm trading. So for example, why is mindset important? Now I talk about my mindset. My mindset is not so much of a buy and hold. I'm more of some sort of a swing or maybe positional. I'm more interested in something like a 1 week to a 3 month time frame. My mindset is really not that which is like a multi-year time frame. Now again, this is just me, and these are very subjective and personal. I'm just sharing mine. So if I'm using this setup to trade on a monthly time frame, then on a day-to-day basis it may not work. And I'm not really that sort of. I may have just like a very small portion of my portfolio, just maybe 10 or 20% of my portfolio, which is that. And for that, I normally don't rely on this. I rely on this one for longer ones to identify the trend. For me, this is most useful in trading opportunities. So my mindset is more towards that. If my mindset is a weekly kind of a thing, then I'll probably use maybe a 2 hourly or 4 hourly. Because again, in my back testing, what I found is not only this strategy, but a 4 hourly chart works very well for a 2 to 4 week time frame. A daily chart works very well for a, say, 1 to 3 month time frame. A weekly would work something like a 1 year time frame, depending on what. So again, these are just averages, not really rule of thumb, but these are averages. So if I'm looking at a weekly time, my trading time frame is like a week. Maybe I might start off from, say, in the hourly. I'll see whether hourly is giving me that. Maybe 2 hourly might work, maybe even 4 hourly might work. But in a weekly time frame, in a 1 week time frame, in a 1 week trading time frame, maybe my weekly chart may not work. Because why? It may work in the sense of working as far as the idea is concerned, but my risk reward may not be that. So my risk is adjusted to what my trading time frame is. If I'm looking at a monthly, then I must have the capacity or that much account also balanced so that it can weather, it can cushion in the event that stop gets triggered. So depending on what my stop loss is, depending on how much I'm willing to risk in a particular trade, depending on what my trading mindset is, accordingly I will devise. But Alex, please, by all means, share, jump into here and share your perspective also. Appreciate that, in fact.
The audience would love to hear your perspective. So, the stage is yours today. So I will let you answer the question. So I think maybe you can answer a few more questions. Okay. So I see a good question from Yong over here. He asked you whether you use the EMA, the exponential moving average, because there are a few types of MA, like simple moving average, exponential, even weighted moving average. So which kind of moving average do you use most of the time?
So it's the exponential moving average because it tends to give more weight to the recent price action. One can go, and I know that some of my friends also use simple moving average for this strategy, and they may use different so some people may use like 10, 30, 15, 25, 20, 40, 20, 50, depending on, so it may vary according to. The important thing is just following that. It doesn't matter that it has to be 10:30. Again, this is not a rule of thumb, it has to be 10:30, but it's just that to follow, once you have set something, just follow that discipline in that sense. And yes, so it is, to answer your question, it is the exponential, but it can also work in a simple moving average. But I just tend to use exponential because I want the most recent price action. I want the turning points to be captured faster than the simple moving average.
Okay, thank you, Manish, for the answer. And maybe one more question, okay, is from Ash. Okay, so he said that, please throw light on the exit of this strategy. So I believe Manish already answered this question. He mentioned that, when your profit, it is, 1:1, you can consider exiting some of your position to take profit. Am I right to say that?
Correct. So one method could be just, again, and why I'm saying this, so this can be also coded, by the way. This can be coded also. I've also coded this in Metastock. It can be coded in TradingView also. There's no problem at all. One can code in also. One can add one or two indicators. One can either add stochastics or say CCI to be able to get additional confirmation if I'm coding it. But if when I realize that if I'm coding it, then how do you, set up, subjective parameters like, okay, high of the previous bar, but, like the high of the pivot. How do you know that? So in that case, what I realized is that 1:1 works very well. That I know that, okay, you set the stop loss as the previous and add up the profit is just adding the difference to that from your entry point, which is the high of the, above the high of the previous bar. So in that case, 1:1, if you're coding it, might work well. But like we saw earlier, that it's not necessary that only 1:1. What I found in my experience, 1:1 is probably the minimum that you can expect. But at times the market is willing to give you more. So one is that, okay, once I get 1:1, I can immediately set my stop over, raise my stop to that 1:1. Then I'm prepared not to go, I want to minimum capture that. But by that way, I can also sometimes ride that trend. Like we saw that maybe the high of the previous bar was much more than 1:1. So that could be other. But if I'm starting, it's a very good question actually. If I'm starting, let me just start with 1:1. Once you get more familiar with it, once your eyes get trained, once you understand the nuances in terms of, okay, how the wide the average is, how narrow the average is, the distances, all that, then you can fine tune, and then that, okay, if the gap is really wide, more often than the market will give you more than 1:1. If the gap is really wide between the two, if both are really, largely if the 30 is sloping up, maybe the 10 might, because it's a retreat, the 10 might exponential might just change the slope. But as long as the 30 is up, the broader trend is up, in those cases, you might get more than 1:1. So there will be, as you play along, as you, move along, you will come across cases where the market is prepared to give you more than 1:1. But like I said, more than 70% of the time, at least in the first instance, it works. And likewise, just one final comment on this, that by all means, please do test it out. Don't just buy it because I'm saying it. Just test it out on your own, see what works, whether it works. If you have a better system, then by all means, just follow that. We are all here because market is so huge that it is giving us opportunities, everyone opportunities to participate and to at least make something out of that. So with that, I think I've already run out of more than enough my time. Alex,
We can answer one more question. I think there's one good
fine,
question.
fine.
But one last question for the audience, okay? So by Raymond over here. So if the setup is right for the trade entry, but there are some announcement, maybe some news event coming up. So whether do you still go ahead to place the trade, or you stay aside first to wait for the events to be over first?
Okay, so this is purely if I'm giving the machine the algorithm to the right to execute for me, then the machine doesn't know what the news is and anything. The machine only goes on price. So in that sense, I have to just be vigilant about price. So I don't normally look at news in that. But if you observe by and large, again, if you observe by and large, as you start to do it, the news flow will be largely in the direction of what the reversal is there. So when the trade setup is there, when the high is there, you will have some sort of a news flow which is really positive. The other thing is, and I'm saying this because I started off my career as a reporter, a news reporter. So what I realized is that sometimes you may have seemingly in your mind, it's a bullish news, but the market goes the other way. So how do you define a news item which is positive or negative? That assessment is also my assessment that I think it's a bearish news. I think it's a positive news. As long as the market gives that assessment that what the market thinks is more important than what I think. So hence, again, this is also a way to minimize my subjective bias as to I think this is a positive or I think this is negative. Let the market decide whether it is positive or negative. And of course, it may also be the case that we may have a signal which is bullish and maybe the trade might go wrong. That also can happen, of course. It will happen. But at least the trading conditions must be satisfied in that. And whether, we can all bring in the other filters like, first time, second time, third time, fourth time, fifth time, when the trade is, gone and on in that phase. But yeah, thank you very much for joining in today. I know it's past lunchtime also for many of us. So, sorry for making you stay away from lunch and also away from your other activities on a Saturday.
No issue. Very good sharing from Manish.
And I look forward to talk to you. Like I said, I'll wind up again one last sentence based on what I started with. At IG, we really believe in empowering our customers with financial freedom. We want you to be independent. And this is a step in that direction. So I hope, we all found it useful. By all means, please send your comments, suggestion, feedback on how we can improve it further and what you'd like to hear from us, from IG the next time. Pleasure to talk to you, and I'll see you again.
Once again, thank you, Manish, for your sharing today. Back to you, Jeremiah.
Thank you so much, Manish. I think, you can hardly complain when it is a session that overruns, but it really, really gives so much value to all of our, attendees of the event. So thank you so much, Manish, for staying with us for this Saturday afternoon session. The next session is going to be starting in 3 minutes, actually, at 1 p.m. And it's going to be delivered by Jay Tun, who is the founder of Swim Trading. In this session, he'll be talking about unveiling hidden treasures, mastering stock market opportunities in the high interest rates era that we find ourselves in. All right. So this session is going to be in a separate Zoom room. So please do not stay in this Zoom room. This Zoom room will be closed. I believe Alex just shared the link to the next Zoom room with Jay. So please click on that link and join us there, and we'll see you at 1 p.m. All right.
Yeah, so please don't stay in this room. See you in just 3 minutes time. All right. So thank you. See you later. Bye-bye.
Right. Thank you. See you. Bye-bye.